Welcome back, everyone, to Money Show's accredited virtual expo. We are pleased to have Louis Navellier today. He is the editor of the Growth Investor Breakthrough Stocks and Accelerated Profits. He's one of Wall Street's renowned growth investment advisors. He's the founder and chairman of Navellier and Associates, a money management firm. Mr. Navellier specializes in behavioral finance and utilizes extensive quantitative and fundamental analysis to identify market-beating stocks. He's the editor of 5 investing newsletters, which are published through Investor Place. Louis, such an honor to have you here today. It's all yours.
Well, thank you. Well, folks, for the next half hour or so, I'm going to talk to you about why inflation has come roaring back, but Treasury bond yields are falling, and to prepare for something called MMT, modern monetary theory. So we're entering a kind of a scary time for yield-hungry investors, but it's very, very bullish for stocks, and I will give you my best stocks, especially best dividend stocks as well. Okay, so let's talk about our Federal Reserve. Our Federal Reserve is in a conundrum. They have 2 mandates from Congress. One is to control inflation. 2 is to keep us in full employment. The reason the Fed hasn't been fighting inflation and is going to let it go well beyond their target ranges is they're trying to fulfill this unemployment mandate. There are 6.8 million jobs that have not come back since the start of the pandemic. And the Fed really feels it must restore those jobs. Now, the labor force participation rate is actually down 2%. Some people chose to retire. Other people may be choosing to collect extended unemployment benefits rather than work. As I speak to you today, I'm actually in Baltimore. And in Baltimore, it's very interesting because a lot of the big chain restaurants remain closed because they can't find the workers. So I'm sure you are keenly aware there are a shortage of some type of workers, IT people, construction people. A lot of service industries are having a hard time finding workers. And this is the Fed's dilemma. They're missing 6.8 million jobs. So that's why they're going to keep interest rates ultra low until all the jobs are restored. Okay, the other thing that's going on is our government caused the amount of currency or dollars outstanding to explode. And when you throw money at the problem, you create inflation. So you obviously know residential real estate's gone up, the stock market's gone up, even cryptocurrencies for a while went up. Money's just sloshing around. It's chasing art, it's chasing collectible cars. It's quite interesting. They know what they're doing, okay? They threw a lot of money at it to have the shortest recession on record. This little purple band are recessions. And you can see that our recession from the pandemic was the smallest one ever recorded. So that's the good news. The bad news is now the amount of Treasury outstanding are going to cross over 100%. And at the end of the first quarter, it was over 87%. But we're going to be over 100% debt as far as GDP is concerned soon. And a lot of people think this is unsustainable. And as a result, the Fed's never going to be able to raise interest rates. Now, just so you know, the interest on our federal deficit is bigger than the entire department of the Defense Department. So they can't let rates go up. It'll break the economy. So they're going to be forced to keep rates low, even if we don't have inflation. But now we do. Okay, now our Federal Reserve has been buying back $80 billion a month in Treasury securities and $40 billion a month in mortgage-backed securities. And this is called quantitative easing. And there's a lot of talk that they want these guys to taper, okay, which means curtail this activity. However, the European Central Bank last week increased their quantitative easing. So that's taking all the pressure off our Fed. Now, our Fed has a statement tomorrow, the Federal Open Market Committee statement. I'm expecting a very dovish statement, okay, because our Fed, in my opinion, even there's a minority of Federal Reserve presidents that want to start tightening and curtail the tapering, the money printing. uh, our Fed is going to remain very accommodative, and that's what I foresee. Oh my God, let's talk about inflation. The CPI inflation is hideous. Look at it. There it is in blue. Compared to Europe and Japan, they don't have the inflation issues we have. Europe, by the way, said they will not raise rates until inflation hits 2%. They're at negative 0.5% right now in Europe, just so you know. So this inflation is uniquely an American problem right now. And it's all in commodity prices. Now, some commodities have peaked. Lumber went up 140%, then pulled back 2/3. Oil has skyrocketed. We expect oil to moderate after September when global demand starts to ebb. The reason that happens is, so you know, there's more people in the northern hemisphere than southern hemisphere. So what happens is demand just naturally falls off. Okay. Well, a couple other things are going on. But the main thing is commodities are priced in dollars. Our dollar, when it's weak, will cause commodity inflation because the dollar declines, so all commodity prices go up. The dollar did get its mojo back here a little after last week when the European Central Bank decided to up their quantitative easing. But I'll tell you, it's we're in a very, very interesting conundrum right now. Europe has negative rates. Britain was trying to fight negative rates. They're falling in the negative rate trap. We will eventually fall in that negative rate trap as well. But first, the 10-year Treasury will probably have to break the 1% barrier, and we'll have a hissy fit. But we're headed to negative rates in my lifetime. Okay, home prices have been an oasis in this inflationary environment. Median home prices have hit an all-time high recently. And it's interesting. New home starts have fallen for the last 3 months. Some of this could be the price of commodities going up, lumber, copper, PVC pipe. That big freeze in Texas caused plastic PVC prices to skyrocket. But there are ways to protect yourself in an inflationary environment, and one is your home. Another is the stocks that can profit from this environment. So let's talk about Europe, because Europe is really kind of messing the whole party up, for lack of a better word. In yellow, it shows where European yields were a year ago. And then a month ago, they were in red. And since then, they've fallen back since with some more easing. So up to 15 years, 20, even 30 years, you have negative rates now in Europe. Now, a month ago, you didn't, but now you do. Okay, let's talk about, sorry, I have Siri arguing with me. Okay, let's talk here a little bit about our yields in America versus Europe. You can see a year ago, we were in yellow, and now you can see where we are in green. And the most fascinating thing to people is inflation has risen and bond yields fell. And that's all that pressure is coming from Europe. See, when their rates fall, they're going to pull our rates down. When they do more quantitative easing, they're going to allow our Fed to do more quantitative easing. So, fascinating environment we're in. Now, this money printing was initially pioneered by a guy named Mario Draghi. He was the head of the European Central Bank. He is now the Prime Minister of Italy. Apparently, if you just print money, you become very popular. And our real 10-year yield is negative now. So if you invest in 10-year Treasury bonds, you will get a negative yield. If you invest in junk bonds, believe it or not, it yields less than inflation. You also get a negative yield. So we're in new territory here. This has happened before in the 70s and 80s, but wow, this is unbelievably bullish for stocks. If you're an income investor, this is tough on you. It's really tough. So you might have to look somewhere else, and a lot of people are going to stocks. Anyway, our economy is still growing. We accelerated. We were 6.4% in the first quarter. They're estimating 7.6% second quarter. Now, those estimates will change. Some people are 9%, but we're going to have over 6% GDP growth in the third quarter. And the fourth quarter is still going to be good. A lot of this is just all the supply chain bottlenecks. And, as the world economy expanded, they just couldn't ship enough stuff out there to everybody. All right, let's talk about the current market environment. The first thing I want you to know is ETFs are messing with the market. Now, in the last couple of days, it's been the Chinese ETFs. China cracked down on Monday on education companies, for-profit education companies. I don't recommend those stocks now, but I have in the past. Those are things like New Orient Education, Tal Education. So what happened is these education companies are for profit, and they cracked our SAT exams in America some time ago. And that may explain why a lot of Chinese got into our fancy colleges. And they've changed the SAT since. But just because China's having a crackdown on education companies doesn't mean you got to hit all the other Chinese companies. But that's what's been happening the last couple of days because they're in ETFs. Now, there's a dark thing going on with ETFs I want you to know about, and that is ETFs have spreads. This is the SPY. This is the largest ETF out there. And in the last decade, if you had bought SPY at the close and sold at the opening, you'd be up 116.64%. That's the green chart. But if you bought it at the opening and sold at the close during market hours, you'd only be up 59.98%. But if you just bought and hold it, you'd be up 246.58%. So this is shocking to a lot of people, just how big ETF spreads are. And ETFs can trigger serious market corrections like they have in the last couple of days in Chinese stocks, because those ETFs are not trading at market value. They're trading at a deep discount. And I've seen the discount on ETFs be as high as 34.95% intraday. That happened in 2015 on an ETF called DVY. That's the iShares Dividend ETF. I think it's the fourth largest ETF in the country. Yet that ETF went to a 34.95% discount immediately for 90 minutes. At the end of the day, it was as if nothing ever happened. The discount disappeared. So you've got to be careful trading ETFs. If you put in a physical stop order, you'll get cleaned out. So don't ever put a physical stop order. Always place your orders at or near something called the intraday indicative value, the actual value of the ETFs. You can find that by going on to Morningstar.com. But I just want you to know the boom in the ETFs is exacerbating the market's volatility. And that's a new complication we have to deal with right now. The good news for you folks is corporate America is selling bonds at a frantic pace, and they're also selling new stocks. But you can see that the bond issuance for this year has been over 3 times the stock issuance. Okay, so that's good. And corporate America is selling these bonds, redeeming their existing debt, and then also letting cash build so they can buy their stock back. So the foundation of the market is fine, thanks to low interest rates. And if we look at the S&P 500's historical revenues per share, valuations are going up, okay? And this is an example how the stock market can protect you against inflation. So where do you go hide when inflation reappears? Well, you can go to your residential real estate, you can go to the stock market, and the inflation is just going to make sales and revenues go even higher. Okay, here we go. Here's the S&P 500's earnings and revenues. Just so you know, we're hitting peak sales and earnings momentum in the second quarter. This is for the first quarter. But it's amazing. Our economy has record profits with 6.8 million fewer workers. The pandemic accelerated the productivity gains in America, and that's one of the conundrums the Federal Reserve has right now. And here's an interesting chart. This is the S&P 500, okay? These are earnings revisions for the S&P 500. And you can see the analysts have been very positive and revising their earnings estimates higher recently. So that's a very, very good sign. And we're having very good surprises. In fact, as I'm talking to you, Apple just surprised. Yesterday, Tesla surprised. Okay. As far as the manufacturing sector, it's a little more volatile, but it's been booming. And we just had durable goods come out today. They're up for 13 of the last 14 months. That's a good sign. And there's a lot of supply chain bottlenecks, a lot of big order backlogs. So expect the manufacturing sector to continue to do very well. All right, this is a very interesting chart to show you. This shows you where the best performance is in the S&P 500. And I'm borrowing this chart from my friends at Bespoke. And they show you this thing called Decile performance in the S&P 500. And if you wanted to have the best performance in the first half of this year, here's where you had to invest. The bottom 30% of stocks with the lowest share prices did the best. The bottom 30% of stocks with the lowest market cap did the best. And then we have some interesting charts. The stocks that have the highest percent above their moving averages, the top 10%, were up 27.72. And then that's a 50-day moving average, that's a 200-day moving average. The stocks with the lowest P ratios did very well, up 21.95. The ones with the lowest price to sales did well. The lowest book to price did well, and Dividend did amazingly well. So Dividend stocks have been on fire, okay? And as we go down this decile chart, back up here. The stocks this is the bottom 20%, the highest short interest did well because of short covering. The worst analyst revisions did well because of short covering. International revenues they were somewhat okay. And then this is fascinating. The ones that did the worst in 2000 did the best here, especially the bottom decile. So what you're seeing here, this is called a value rally. And I'm a growth manager, and we let value run and rally every now and then. But we like the value stocks that are earning money, but the ones that aren't earning money, we don't like. And we do think Wall Street got sucked into a value trap. And I do want you to know when we get these value rallies, it's not that bad because it makes the market broaden out a bit. But you can see the market is now gravitating back to earnings. And I think you're going to see the stocks that are going to have the best earnings and the best guidance are going to do the best, whether they're growth or value. All right, I want to talk to you about how we grade stocks. We look for something called an alpha, which is return independent of the market. It's uncorrelated the market. Then we divide the alpha by volatility to get a handle on risk. And our reward risk ratio is an alpha or volatility ratio. And we start to punish stocks as they become increasingly risky, increasingly volatile. I was talking earlier about Chinese stocks. I have been a net seller of Chinese stocks as they've been getting more volatile. Now, I still have some left. But, as any sector gets volatile, I'll trim. And here's how our stock graders performed. This is our quantitative grades on alpha over standard deviation. The A's are in blue. The B's are in red. The C's are in yellow. And then the D's and F's are taking up last place. Now, one thing I want you to know, we do take 3% off the top of all these charts. So these are a net of a 3% estimated for spreads, okay? So we don't take that off the S&P, but we do take it off our charts. Then we do some fundamental analysis where we identify the key fundamental characteristics that we think are working on Wall Street, and we backtest these variables, make sure they work, and then we weight them. So let's talk about some of our favorite fundamental criteria. Here's how our fundamental models are working. We rank stocks on sales growth, margin expansion, earnings stability, earnings momentum, cash flow, return on equity, analysis earnings revisions, earnings surprises. And the stocks that get an A are clearly doing better than the stocks that do a B, C, D, or F. Again, we take 3% off the top. So we want stocks that usually are an A or B fundamentally with a high quant score. And we combine them to get our total stock grade. So our stock grading service is online free to you folks. Some people go to our management company to get free portfolio checkups. But I do want you to be keenly aware, okay, that these are very powerful tools and they're also free for you in the public domain. So take advantage of them. So here's an example of some stocks, how they've performed. We have a telecom company that gets a C, a pharmaceutical that gets a C, another telecom, a medical specialty company gets a B, and a restaurant company gets an A. So these are all examples of how we rank key stocks. This is just a sample for you. So let's talk about dividend stocks, because dividend stocks are really benefiting from the collapse in yields and the rush to modern monetary theory. Okay, we have now the 3-month Treasury bond yield and the S&P 500 dividend yield. And you can see the 3-month Treasury bond yield is below the S&P's dividend yield. Folks, that's so bullish. I can't explain that enough. Incredibly bullish. So, I mean, stocks are screaming buy. Here are the S&P dividends over time. They tend to be slowly increased. So when you buy a stock that pays you a nice dividend, that dividend is going to be slowly increased over time. You can see that they can pull back as they did in recent quarters, but they come roaring back in the last couple through the first quarter. And right now we're on track for over 6% dividend growth. This is dividend growth rate since 1945. And we sometimes grow at different rates, but right now we're growing a little over 6%. So if you buy a stock that yields you 3.5%, and the dividend is going to go up over 6% a year, that's going to protect you against inflation. And here are example what's going on dividends and buybacks. You can see the amount of dividends are increasing. Here are the buybacks. They've started to reaccelerate recently. The buybacks that have been announced this year are the strongest in 22 years. So those are buybacks have been announced. The companies haven't necessarily done the buybacks. Well, they've done some, but we do expect this to get a lot more bullish shortly. This is our dividend grader. It's similar to our stock grader, but anyway, we rank stocks on an A, B, C, D, and F basis. And interestingly, the dividend stocks did not protect you last year when the market had its correction because of coronavirus. But boy, they came roaring right back. So we believe that dividend growth is one of the safest places to invest in right now. And I showed you evidence earlier that the top decile of stocks in the S&P with the highest dividend yields were doing amazingly well. Let's talk about some of our highest rated dividend stocks for you. One is Arbor Realty Trust. Still yields over 7%. It's technically a REIT, but it gets a coveted A rating. Another is American Financial Group. Only yields 1.55, but a good dividend growth stock. Another is Escalated, which makes recreational products. The whole outdoor camping boom yields 2.37. Again, A grade. Evercore Investment Bank yields only 183, but gets an A grade. Hamilton Beach, which is obviously appliances for your home, mostly in the kitchen. It gets an A grade, has a dividend yield of 1.88. Haverty Furniture gets an A grade, dividend yield of 2.32. And then B. Riley, an investment bank, gets an A grade, yields 2.48. So those are examples of some of our best dividend stocks. Here are some of my best growth stocks. A couple things about growth versus value. They move inverse to each other. You can see that value started to firm up here a little, but it hasn't done anywhere near as well as growth since 2009. There's a lot of value managers out there that are manically depressed, and I feel sorry for them. I think they need therapy, just so you know. But in the strong growth environment, it really favors growth stocks, and you can see revenues are soaring. And we like companies where the earnings grow faster than revenues from margin expansion. All right, here we go. Here's the growth, how it performs when the revenues are really good. And you can see we're in an extraordinary period right now. So when revenues contract, we can get in trouble, but revenues are booming now, and we're doing great. And look at the earnings forecasts. This year, earnings expectations have been revised higher. For next year, they're being revised lower, but last year they were revised up. But this year is going to be on track for the best year ever for earnings, 31.2% for the S&P 500. Next year, they're forecasting 11%. And here's our stock grader. You can use our stock grader to find the creme de la creme out there, but I'm doing that for you. So here you go. One of my favorite stocks, Big Five Sporting Goods, gets a total grade of A. This is a sports retailer. This company sells a lot of guns, just so you know. Here's Clearfield Communications, had great earnings last week. It's a 5G play, doing very good. Here's Cambrian Networks, another 5G play, gets an A. Fluent Genetics, medical nursing home services, gets an A grade. And Futu Holdings is actually a wealth management company in China. They've been hit in the last couple of days with a China sell-off. Actually, they're in Hong Kong, just so you know. But they'll be fine. They're forecasted, the revenues are forecast to go up 193%. Here's some more. Here's Turtle Beach, which makes appliances, hearing aids. Hibbett, which is specialty stores based in Birmingham, Alabama. They make sports apparel that's very comfortable. Havity Furniture, again, meets our dividend model and our growth model. Insure Direct's doing good, and so is Logitech. They make it's a Swiss company that make video game controllers. A lot of kids were playing video games during the pandemic. All right, it's time for some questions. Okay. So I just have a few minutes here. So when will rates be negative in America? That's the first question. Well, right now the tips are already negative. Treasury, inflation, protected securities are all negative on any maturity. So we already have that. But when are absolute rates going to go negative? Well, it may not happen under this Fed chairman, but if we get a very progressive Fed chairman, which we might under Biden administration, I would not be surprised if it happens within a decade. So maybe by the end of this decade, we'll have negative rates. We're going to fight it. We'll bounce around. We'll go positive. But folks, by the end of this decade, our deficit's probably going to be $50 trillion. So, you just can't raise rates when you have that much debt. And this is the conundrum Europe got into. They issue more debt than the financial markets can support. So the central bank just prints more and more money, and that's exactly what we'll be doing. We'll be following Europe down this interesting path. Okay, here's another good question. What about gold? Is gold a good hedge? It can be when there's a lack of confidence in central banks. It looks like the cryptocurrency market has been stealing some of the money that would normally go to gold. But, I have no problem if you buy gold. I'd rather you buy physical gold. Please be careful of the spreads. I do not like you buying gold in ETF. So I'd rather you not do that. Okay. All right, and here we have one last question here. Oh, what's my favorite stock? Well, it just depends on the day. I'm very excited about Navellier, an AI company. Makes great chips. I'm very excited about one of my stocks that has not released earnings yet. Microelectronics, they make the chips that are in short supply. They're from Taiwan. One of my favorite Chinese stocks that's been beaten up here is NIU. They make electrical bicycles and scooters. They actually make more electrical vehicles than Tesla. I like them quite a bit. But I always have good stocks for you guys. And time for one more question. One of my favorite companies profiting from gun sales. Well, there's two of them, CLAR and VSTO. They're in the ammunition business. CLAR, Claris, and VSTO, which is another ammunition company. So, folks, it's been an honor to talk to you today. Anything we do to help you, let us know. We're here to empower you, make it more help you with your portfolios. The markets will be getting more narrow in the upcoming months, and I think our stock grading will be more important because we're kind of going to go through a funnel, and we expect to have fewer leaders going forward. But we're still in a rip-roaring bull market. It's still what we call a Goldilocks market of low interest rates, strong earnings, and an accommodative Federal Reserve. Tomorrow's FOMC statement will be critical. I think you'll see evidence our Fed is still dovish. So thank you again. It's been an honor to talk to everybody at Money Show, and I hope to see you at a live Money Show sooner than later, like in Las Vegas soon. Take care, everybody.
All right, a big thank you, Louis Navellier. Always a pleasure to hear him speak. We appreciate him taking the time out and joining us. So thank you very much. And thank you, everyone, for attending.